Hey, good morning, everybody. Welcome to the Ankerstar Wealth Morning Show. Rough day yesterday. You may have noticed we just got word it was the sixth worst day for stocks since 1950. Kind of crazy, but not even the worst day this year. If you remember back to August, that was the China pair trade, and I mean the yen sell off and all the exciting stuff that was going on then. So it's not even the worst day of 2024. But these things do happen. Even in a straight up market, I like to say it's like thunderstorms rolling through paradise every now and then. Markets recovering today. Mike will talk about that last. As you may have noticed, it's been Mike and Corey lately. You'll see some more of that going forward. I've been off working some other things, especially with the building come up. So for days coming up, for today's show, I'm going to talk about. I'll go first. I'm going to talk about just kind of an update on where we are as Ankerstar Wealth. Then I will transition into some proactive tax strategies, which I'll explain why we're talking about that, and then I'll hand it off to Mike, and he's going to talk about the fun market stuff. Excuse me, at the end. But before we begin, remember this is an academic financial presentation. You have to do your own due diligence before acting upon anything you hear in this presentation. More disclaimer information is available at ankerstarwealth.com, and the opinions expressed are Mike and mine alone. Let's share out this screen here. And the first thing is Ankerstar Wealth. This is a boring screen. It's brokercheck.com is what you're looking at. But excited to announce that we are through the SEC registration process. So if you've heard me talk about that, right? You're kind of if you use sports analogies, you're JV, junior varsity up to 100 million. Once you go over 100 million, you have until 110 million to register with the SEC. And we have done that, and we're sitting at about 110 million right now. So this broker check is where people find us publicly. So this way you can see we now have a CRD number, which is what the FINRA style number, then an SEC number. What difference does that make to you as a client and or a potential client? None. None whatsoever. We just have to answer to the SEC now instead of the state of Texas for our oversight. So that was the first thing I wanted to share with you. Second thing I want to share, we have a new person on board for the winter. We have Grayson with us. You can see her bio on the website here. Briefly, she graduated from her undergrad from Tarleton State this summer in business, as you can see there, and she's pursuing her master's in accounting. You may have heard me mention in the past that CPAs are very difficult to find and CPAs that have capacity. So we're excited that she's studying accounting, and then we'll talk more about this summer and in the future. But I wanted to also show you she played D1 volleyball there at Tarleton. She played indoor and also she's currently playing beach. So very excited to have her on board with us. Lastly, building update. I know I've told you we were in the building because it was almost assuredly that we were, but we are not. December 30th, I was just out on site a few minutes ago. We're closing on December 30th to get everything in place and get the keys then. There's been a little bit of a learning curve between both myself and the development crew that's out there as far as what needs to be done before you can move into a commercial area. Very different than residential. We had kind of used residential as the model. So they had to do a whole bunch of work with the whole complex to get the whole complex up to speed before we can move in. But as you can see that the picture of the Ankerstar Wealth family office, fall 2024, that should say winter. And yeah, we're sneaking in under the wire of 2024. We'll have the keys, and then we'll have furniture. January is going to be largely a build out month. So needless to say, all the little pieces that we've been stacking up for the past 6 months getting ready are in storage right next door. So we should be set up and starting meetings probably late January, if you will, maybe early February if we just don't get there. But the important part is that terminology of family office. Again, that's you hear that term, you're now thinking having an estate lawyer as well as a CPA on your team. I have 2 people identified that I'm in talks with. I personally think they'll be coming on board, but we shall see. So we may be able to offer kind of a family office light type service by late spring, maybe summer time frame, and we'll talk more about that going forward. Part of that, now that we have a team approach, is rebranding the company a little bit. If you go back to the early days, we've always had in our signature block like investment management as well as financial planning, and now make this a little bigger here. We're going to put, tax strategy in, so it'll be three. It'll be wealth management, financial planning, and then proactive tax strategies. Because right now, if you're not thinking about it right now, you should be. But the tax year is about to close out. And the proactive piece of that is there's certain things you need to do before the end of the year. So I really wanted to cover this presentation. Shout out to Corey for putting it together. But, things to think about right now, because once the year ends, now you can't make a lot of changes, right? You're just stuck with filing at that point. And then into next year, we want to mature this a whole lot. But we are available for you. If you see this presentation, you have something specific, to reach out to your advisor, and we will get you answers. When you think of standard disclaimer stuff, tax optimization, these are kind of the blocking and tackling of the tax world, and this is stuff that you probably should already know about as an individual. Going left to right there, if you look at the 401k, if you are employed in a traditional W-2 type arrangement, you should have some form of workplace 401k, and if you invest in that, it's got a nice big maximum. You put a portion of your salary away each month or each paycheck, depending on how that's designed, and you go from there. You have traditional and Roth IRAs. I'm not going to go into the difference between the two, but those are individual retirement accounts. So you can have both a 401k and an IRA, and you can have one for your spouse as well. Then you have an HSA, which stands for Health Savings Account. If you have one of those, it would be through your workplace. So you can't have one unless you go through your HR department at work. So that would be talk to your 401k folks and ask the questions, am I eligible for an HSA? If so, there's a lot of benefits to that. And then the last one is what we do for you automatically by managing your portfolio, and that's tax loss harvesting. So I'll talk about those just super quick. Here's your 401k. Again, nice big maximum, put away a couple $1,000s a month. There's a Roth option for a lot of folks and a traditional option depending on how you want to save your taxes, save on taxes, and there's sometimes a match that's involved. The pros are, there's a bunch of pros out there, but the cons also is that you're kind of tied into whatever the menu of investments that you have. So if you are in a 401k and you picked investments, realize that if you started there 20 years ago, whatever investments you picked that first day when you walked in, you're still in those same ones. So again, if you would like assistance with this, we manage 401ks for folks, and we do this actively, right? Make changes about every quarter depending on what's going on for you. So limited investment options, and there are some fees associated with those. IRAs are what you can open through Schwab or any other brokerage account. Minimums are a little bit lower. You're looking about $7,000 a person. You get a little add more if you're over 80. But again, there's Roth and traditional, and you'd have to go through and talk to your advisor about what's best for you. HSAs, I'll let you know if you're eligible for one of these, $4,300 per person. And I'll be happy to run you through the slides that go with those if that applies to you. And again, you can see some of the expenses there that it will cover. Okay, tax loss harvesting, just some basics here. Stocks go up and down. You saw that they went down yesterday. In an IRA, you don't worry about tax loss harvesting because those are not taxable. There's no tax ramifications in those accounts. However, if you have a brokerage account that's a taxable account, whether individual or joint, just realize we scrub those all the time. You want to sell off the ones that are down to be able to write off those losses, and then keep the ones that are going up. So it's where rebalancing portfolio management has you sell winners and kind of add to the places that are down. Tax loss harvesting is the opposite. We're looking to sell things that are down intentionally so we can get reduce your tax bill. So remember, any losses that you have out there offset gains 1 for 1. And if you have an additional losses past that, which the market's been up for the past 2 years, so you probably don't. But if you have unused losses, is what it says down there, then up to 3,000 of it can go towards your regular income, and then the rest is just carried forward. So there's a lot of stuff here. If you understand that, that's great. If you don't, this is something to talk to your advisor about to really save. There's making money, and then which is your job, and then there's your money making money, which is your investing, and then there's the try to keep the most of it you can, which is the optimization of the tax code, and that's where we're here to help you out with. Those are kind of the basic stuff. So those really apply to almost everybody. This slide, this is our last slide. It's all I'm going to do is show you this and say this is more advanced stuff. But if you are selling a business, if you have, are you selling a home, whether it's a personal or resident or for investment property, any of those things to where you're looking at basically, if you look under the minimums, everything's 100,000, pretty much. If you're looking at $100,000 of gains, into your tax bracket, whether you're in the 24% or all the way up to the 39%, you're going to pay a lot in taxes. So if you have a big taxable event coming up, then that's when you want to talk to your advisor, not after you just sold, because there's many things you can get out in front of and do, but once you pull the trigger and actually do the event, then sometimes you're stuck. So I'll just walk down that left-hand column. The opportunity zone is probably the most applicable to our group of clients. If you look under the qualifying assets, any appreciated asset. So where could that come into play? If you moved big into Bitcoin on January 11th when the ETFs came out, it's basically doubled or tripled since then. So if you put 50,000 in, you may be sitting around that 100,000 level of gains. Or if you bought Apple a decade ago, you could be sitting on large gains to where if you sell, then you're going to end up owing taxes on that. This is your out. This is a way to defer the taxes that you owe and then have everything else grow tax-free. It is not easy to explain. I generally, when I talk to clients, just kind of throw it out there. If they're interested, I will talk about the basics of it. And then after that, I will hand them off to our Opportunity Zone folks that help with this. But I will tell you that it is the best deal going. My parents are in it, so I mean, it's exactly the way to go. Direct indexing, that's too complex to really explain, but it does help you save taxes. If you're donating money, and talk to us first, because you may be able to get better credit for it than just writing it off on your taxes. There's a couple of options out there. And then if you deal with real estate at all, there's two at the bottom to where they're absolutely the way to go if you're on the investment real estate side. So that's all I'm going to have for that. I'll bring that down and then just kind of wrap it up before I turn it over with Mike. But again, you talk about a differentiator. We're really good at managing investments. You've seen that this year. Very proud of that. Our financial planning, we have a financial plan for each of you in Money Guide Pro. Sometimes we show you that, sometimes we don't. And all of that comes together through Black Diamond. So again, if you want to see it all in one place, just reach out to us and see that, ask us for that Black Diamond login and we will get you all set up. And then the last piece of that is, again, for 2025, really hammering home on this proactive tax strategy piece of this too, and that's what a lot of folks out there aren't doing. So with that, super excited about it. I'm going to turn it over to Mike to talk about the market. Over to you.
Yes. So yesterday was a fun day. I know when Corey and I did the show, we said, hey, the Fed's coming out with the next discount rate cut, very expected to make that quarter-point cut. But what they say could affect the markets. As I said yesterday, unlikely to be a good news, like where markets would shoot up, and is exactly what happened. They made the quarter-point cut as expected, made some minor tweaks in the language, and showed their Fed dot plot, which I'm going to share in a moment, but that caused the market to sell off. It was almost like the Fed discount rate it's like candy that's being passed out. And they said, here's your piece of candy today, but next year we're going to give you less candy. And everyone went, oh no, temper tantrum. And the market, reacted accordingly. I'm showing the graph of the S&P just to show you it's up 0.37% today. But overall, just to show you the year to date, and you can see the drop in August that Steve mentioned, and you can see, just the drop yesterday. I can see about 5 times this year we've had a drop. Might not have been in one day, it might have been over a few days, but you can see those dips in April, August, September, November, and then, But when you step back and look at the overall market year to date, it has been a fantastic market. It is up significantly. And when we have those dips, that's why you get a good return. And that's also chances to buy things on sale. So I just wanted to kind of step back and take a look at the good news. And if you didn't look at things yesterday, great. That's fine. You don't need to look. I wanted to show the dot plot, and this was the big reason, or one of the reasons why the market sold off yesterday. And what this dot plot is it allows, Jerome Powell, is the main driver, but it gives everybody a chance to vote. And so each dot represents one of the key people on the board there. And you can see that, like, for example, for 2024, they're all pretty much in agreement. You can see a lot of dots together, 100 basis point cut, which is what we have through yesterday. But then when it goes into next year, this is a projection. So they have, kind of a majority are saying it's a 50 basis point cut. So that means two 25-point cuts. That's what they're saying. And then 2026, it's harder to figure out. It's not as much of a majority. And then 2027. But they do this every quarter and to kind of give everybody a vote and a look towards the future. As far as the actual language in the statement yesterday, I looked at it. It was so minor, but it basically said, step back. We're not gonna hand out these 25-point cuts as frequently. And what the Fed is looking at is the combination of growth of the economy, GDP, and inflation. And they're just projecting out. So I did not see anything that would make me panic and like, oh my gosh, either inflation spiking up, that would be a concern. That'd be my bigger concern, or the GDP slowing down too rapidly. I didn't see either. So the Fed's just managing that, and the market reacted accordingly. The one thing that I would say is the real downside that I saw, and I'm going to bring up the 10-year bond. So you can see that has went up as far as the percentage, and where this impacts things is borrowing for financing or refinancing of houses. So back in September, the 10-year bond had went down, and if you were looking to refinance or purchase a house, the rates come down accordingly. But since then, it's went up, and even yesterday it went up, and today it's up. So all of that to me is not good news if you're looking to buy a house or refinance your house. So we'll see where these go. But I did find this article that came out yesterday that, guess what? November home sales surged more than expected, boosted by lower mortgage rates. And I'm going to go back over the graph so you can see that it did dip at the beginning of December. So that's why there was at least a little bit of a surge. And I'm not going to dive fully through this article, but what it does say is there is less inventory on hand being sold than typical. It's like they usually look for like a 6-month inventory, and I want to say it's about 3.5 months of inventory. So that means there's less people putting their houses on the market for sale and less being purchased. So it's not as many transactions happening. And I can totally understand that as a homeowner that has a good interest rate. I can't imagine selling my house right now because I would have to go buy another house and pay a much higher interest rate. So you have this reduced transactions happening. And this is more my concern for next year. We don't have a lot of real estate in our portfolio as far as investing, but this affects you. If you're out there thinking, I might want to sell my house or might want to buy a house or refinance a house, this is going to slow you down in 2025 until these rates come down. So that's what I have, Steve. Markets, rebounding a little bit today, certainly not back to where it was at the beginning of yesterday, but we'll continue to watch this through the end of the year.
Yeah, they call it kind of the dead cat bounce a little bit, right? So go back to that 10-year chart real quick if you can share that again. And I find this fascinating, and this is where I'd advised a couple people to wait on refinancing, because when you think, oh, okay, the Fed is dropping rates, right? And they dropped it down 1% this year when you look at 2024 in totality, and they're projecting to continue to drop it down. Well, looking back though, had we known that the 10-year was going to act like this, the expectation was the 10-year was going to continue to drop. It certainly has not, right? It did until September, and then it comes raging back. Very difficult to really explain all the things that go into that. But yeah, unfortunately, the time was to, if you were going to refi out of a 7% plus residential rate, or yeah, residential mortgage rate, it would be back in September. But I will say now, I would just wait. We'll see next year if they do these the 2/4 point rate drops that they're forecasting. If they're going to do them, I think it will be earlier in the year. So again, just suck it up for a little bit longer there, and then if you're looking to refi, I think you're going to get an opportunity, maybe second quarter of next year. So good stuff, Mike. That's all I've got. Thank you so much for listening in. And again, if you want to talk tax stuff, reach out to any of the Ankerstar Wealth team. And you do have 12 days of the year left if you need to make any major changes. So get in front of it, and we'll be happy to help. With that, we'll talk to you later. You have a good one. Bye.